Hello and welcome to another FX Times Daily Market Recap brought to you by CMS Forex. I'm Market Analyst Nick Nassad. Today is Wednesday, November 2009. In today's action, we saw a rather sharp slide in the pound-dollar pair, which here we see with 15-minute candles. The reason for the decline was comments by Bank of England Governor Mervyn and the Bank of England following the Bank of England quarterly inflation report. The main thrust of the down move came as the Bank of England has indicated that it might not have ended its efforts to stimulate growth, having forecast that the UK economic recovery will be slow and hindered by weak bank lending and government efforts to cut its debt. Last week we saw the Bank of England extend its bond buying program to £200 billion from £175 billion, and since the extension was smaller than previous increases, investors and other traders may have taken that as a sign that further moves were unlikely. However, in today's comments, Mervyn said that conclusion may be premature, and in his press conference, he said that the bank has a completely open mind as to whether we would do more asset purchases. That resulted in this sharp reaction here, with the pound being sold off against the greenback following its peak here around 1.68. We slid all the way down to 166.20 and then consolidated in the first half of New York morning trading. The high here came following the UK claimant count, which came in slightly better than expected. So a further increase in stimulus, if the Bank of England was to expand its quantitative easing policy, would leave the Bank of England even more isolated than the other central banks, which are already looking to either pause or withdraw their stimulus measures. Also, the Bank of England said that the sterling weakness would be supportive of the economy as it will help to boost exports. So this change of expectations regarding the quantitative easing policy of the Bank of England resulted in this sharp slide, and then we had a second leg down in New York trading as New York stocks opened higher, but then paired some of their earlier gains, which gave the greenback a little bit more momentum. Zooming this pair out to show 1 hour candles, we see that we had a break of a short-term level of support that had set up from yesterday, connecting yesterday's lows, and which helped start this leg down in the pound-dollar pair. If we zoom out even a little bit further, we see that a more medium-term level of resistance was also broken in our big red candle following the Bank of England comments. So that came right around 1.67. A second speed line could be drawn connecting these lows, and that was broken in today's trading as well. So we had some bearish signals here in the pound-dollar pair, but now we're coming up against support from last Friday's low around the 1.6520 area, and that'll be an important indication of whether we see a further move down in the pound pair, or if maybe the bad fundamental data has been priced in, and now traders will now turn to U.S. news such as the Treasury budget deficit and the trade balance coming up at the end of the week. The weakness in the pound extended to the euro-pound pair, which rose in favor of the euro, pushing the pair up from support around 0.8950, 89.45 to test close to 0.9050. That was a pretty strong surge, about 100 pips for this pair. And a look at another fundamental release from the UK, we saw that the claimant count for the month of October, so the number of workers claiming new unemployment benefits rose by 12.9 thousand for the month, a figure that was better than the forecast 20,000. The claimant unemployment rate did rise to 5.1% as forecast, while the ILO unemployment rate, which lags the claimant count one by a month and is an average of the 3 past months, so for in this case it was the 3 months through September, was at 7.8%, which was better than the forecast 8%, and followed the same level in August after that figure was revised down to show 7.8%. The claimant count, this is kind of heartening news because this is the slowest rate of increase in this indicator in 18 months, and it could suggest that the pace of job losses in the UK is slowing. The euro-dollar pair, meanwhile, where we're looking at 15-minute candles again, was under pressure overnight, but after testing near the 1.50 level, we saw a move down as Despite higher gold and global stocks, which should imply some risk appetite, the pair did not push higher past this level, and once US stocks paired some of their initial gains, we saw the greenback strengthen. In this pair, our rally in late New York trading yesterday was met by this consolidation pattern that was going against the trend, but then once we had a break here, we did see a follow through to that rally until we ran into resistance at this level. Following setting up a new low level of support near 1.5010, we pushed through that rather strongly and until we reached the 1.4950 level. Taking this pair out to 1 hour candles, we see that today's action also broke a medium-term level of upward sloping support. On the downside, we have two important levels to keep an eye on. One would be yesterday's low around 1.4940, and the second would be the highs from last week where we were capped around 1.4910. If we zoom this pair back in, we do see that we had a pretty good bounce off of support today, and we'll see if this continues in overnight trading or if this is just a correction to our down move from today's session. In a quick look at the Euro-Yen pair, we see that we rallied overnight following a break below 134.10, but those gains were capped by yesterday's high around the 135.30 level, and just as we saw in the dollar, the euro declined here in later New York trading. The US dollar Japanese yen pair, meanwhile, which also broke through support in the Asian session around 89.70, found a good amount of bidders down here around 89.30, and then following a rally back into our sort of sideways range that we've been seeing for a couple of sessions, there was very flat trading the rest of the way. Now look at the US dollar Canadian dollar pair, one of our commodity pairs. We see that we had an extension of the down move from yesterday's session and Monday's session as we tested the 1.4420 area in today's trading. Zooming this pair out, we see that that level is a 61.8% retracement of our run-up in the greenback against the Canadian dollar from October 15th to the beginning of November. And as you can see here, now we're consolidating around the 61.8 area. We also had a break of a support trend line in yesterday's trading and any strength. Look at a final pair, the Australian dollar US dollar pair managed to move above its high for the year around 99.30. 99.25, which was set in October 21st, and we moved just slightly above that, completing a pretty strong rally in this pair from November 4th. That amounted to, from low to high, of about 420 pips, and we see that we did have a move down in New York trading following this test of our high. If we can quickly connect our lows from yesterday's and today's session, we can also see that we may be setting up a bit of an upward channel here. So we'll see if that develops. Looking at upcoming releases, we have several from the Asian Pacific region, including New Zealand Manufacturing PMI, New Zealand Retail Sales, Japanese Corporate Goods Price Index, a look at Australian employment figures for October, as well as some inflation expectation measures. Overnight, Switzerland posted CEW economic expectations, and the Eurozone reveals its industrial production. Tomorrow, the docket is rather light in the US, though we get weekly jobless claims, as well as the U.S. Treasury budget, a release that can focus attention on one of the twin deficits the U.S. is currently running that in the long run could pressure the greenback. And that'll do it for today's daily video recap. Visit us on fxtimes.com and happy trading.